All right, folks. Welcome to this week's first commentary and market review. So here's the dollar index on the weekly time frame. And last week we were talking about DXY with the possibility DXY trades into buy side liquidity here. And and one of the major things we highlighted was how the markets were going to trade. Now, mind you, I'm going to reiterate on some things so that we can cast our minds back and remember to keep talking points from last week's commentary, because when I go into Euro USD, I'm going to do a lot of review of last week's price action, because I had folks reach out to me, and some did publicly, some did in private messages and stuff. And honestly, I was getting a theme of recurring problems with the markets. For example, one major thing was how a lot of people talked about knowing that the markets were going to trade higher on dollar index, but they kind of like failed to capitalize on the range expansion, the weekly range expansion. And I want you to listen to this, and I want you to go back to last week's commentary and listen to the things I said, because I don't only talk about where price is going to go. I talk about my expectations. I talk about how I'm going to adjust, because when we are making our analysis, there's literally two things we do. First thing we do is to define the drawn liquidity, which is the first thing we always do. And the next thing we do is trying to identify how the market is going to trade. And in my experience, if the markets are likely to draw into a certain target, right? The most important thing you should focus on is the bias, okay? Because how the markets are going to trade there, you won't always get it right. In fact, if you listen closely to last week's commentary, I talked about scenarios that I expect DXY to trade. I talked about scenarios I expect Euro to trade, and then I went into price action and defined what I really thought the markets were going to do. Even if the market didn't do what I thought they were going to do, and the market probably took in another template in delivering price, I won't still start last week surprised, because I covered every single thing I think the markets could potentially do. I covered it in the commentary, right? So when the markets open on Monday and I saw this gap on DXY, I wasn't surprised, because in my words I said we could expect we could see the DXY open up and start trading higher. But the only thing I didn't know that it would be in form of a gap. Now, if it's a gap, it's literally, there's no problem, because there are key things in price action we want to see if we are to engage. Like I said last week, I said we want to see a 4-hour time frame change in the state in delivery, because what that means is that the market has shifted from a sell program to a buy program, okay, or from a buy program to a sell program. That's what the 4-hour time frame change in state in delivery does. It validates the weekly bias. Means when it forms, you can expect the market to start pulling into sell side objective or buy side objective, depending on your bias and whatever. So the first thing we're going to do is we're just going to look at the general outlook on dollar index, and we are going to we're going to talk about last week's price action on euro, and we'll wrap up the commentary. So what do I think DXY is going to do this week? Well, I think DXY is going to be bullish, but I do not know how DXY is going to trade, okay? Because I'm going to show you what it looks like on the weekly time frame. I'm going to show you what it looks like on daily time frame, and I'm also going to show you and talk about my expectation, how I expect the markets to trade likely next week. So while DXY closed bullish, it didn't only close bullish. You can look at this swing high here, this high with the lower high to the right and the lower high to the left of it. This was the drawn liquidity from last week, okay? And we also annotated more secondary objectives on the daily time frame, which we are going to revisit, okay? That's where the high of the week formed, okay? But this was the primary objective. So you can see how this candle closed. I mean, the bodies of the candle closed above the swing point, and that's very salient to bullish price action. You see, when you're studying markets, when you're doing technical analysis, you have to pay very close attention to the candlesticks, because the candlesticks tell the story. Okay, that's how you build narrative when you're running your analysis, is through candlesticks. Okay, and sometimes candlesticks might be misleading, because we saw, last the 2 weeks prior, this candle was primarily in consolidation, and the only way we're able to frame our idea of bullish price actions, because there was sell side grab here, run on liquidity, and a change in the state in delivery on the weekly time frame, meaning we are bullish from a sell program now on the weekly time frame to a buy program now on the weekly time frame. Now, if we are now in a buy program, what's my prognostication, like long-term prognostication? Why do I think the markets might exactly be in a buy program? Apart from the fact that market has priced in into a near-term objective, I want you to look closely on the 3 months time frame. Okay, you can see this 1, 2, 3 candles, this consecutive down close candles. It's the order block on the 3 months time frame, and you can see a short-term look here, and you can see the market run liquidity here, and you can see the market has, there's been an inefficiency formed, an inefficiency formed here. So this is, our sell side imbalance, buy side inefficiency. Now, for those who will be listening to me the first time, well, I dropped this weekly commentary, and if you haven't subscribed to my YouTube channel, and I'm trying to get to 1,000 YouTube subscribers. So it would be nice if everyone can share my channel to a friend or two. I mean, I have 421 subs. If 421 folks, or say 400 folks, share to 2 persons each, I mean, that's 800. So I think we can do it. It's just something to encourage the channel, because there's a lot of BS online, and everyone knows there's a lot of BS online. Just a bunch of content creators, they absolutely do not know what they're doing. I don't like sounding like this, but it's the truth. Okay, it's the absolute truth. And when you're following these folks, you're wasting your time, you're wasting your development. What I do here is I just just give you what you really need, and I fuck out of your face. I don't need to be your face on a daily basis, because I'm also trying to make money, and you're also trying to make money, but I'm trying to make your journey faster. Okay, so you can just focus on the right things rather than just being all over the place. And that's why I thought in the mentorship was very important. Okay, buys, okay, and then a simple model, which is the follow time change day in delivery. Okay, and you'll be profitable. It's as simple as that. That's what it is. So back to business. So this is a 3-hour time frame fair value gap. So I think the markets are likely to draw into this inefficiency. Why? Because markets are coming from a discount, and the last 3 months closed inside the range of this candle, and we are coming off of this fair value gap here, consecutive down close candle here. So the draw on liquidity is this inefficiency from the 3 months perspective. But even if you have that long-term bias, it doesn't mean you can just go into the market and just pick a trade. It gets complicated as you move from higher to much more subordinate time frame. Okay, so why I think this market or this current week's price action might be tricky, depending on how they choose to deliver, because it's kind of like difficult to pinpoint levels on the weekly time frame where you can see the market trade back into and make a continuation. Because if this is a prior swing point, okay, this is previous weekly high, then put in the middle and the right of it. So if this is the previous weekly high, I needed to show the daily time frame. If this is a previous weekly high, which was a prior premium array for buy side liquidity, and the market effectively closed above this high, then we could begin to look at the same level as a reference point to classify for a discount, and we can start looking at this level as a point of support and stuff like that. But it being support doesn't mean the markets can just, even if the market can literally just just open up, trade into this high, which is 98834, and start running for last week's high again. It is very, very possible. But when we look at daily time frame, it makes it a little bit complicated because of how Friday's candle closed, right? So even though we have this old high for a new discount, okay, even though we have it for a new discount, we're going to go through daily time frame, and we're still going to investigate price action and study what the markets are likely and unlikely to do. Okay, so I'm bullish, mind you, very bullish on the XY, and my expectation is for this week to continue to run to the upside. Okay, we have this previous buy side liquidity, the previous weekly high, and this was the daily time frame balance price range I was drawing your attention to last week. In case the markets were by extension going to reach for more objectives, which they did, and markets is priced into that objective. So now the markets are sitting at the previous weekly high, and I need you to look closely here. You can see this consecutive down close candle. This is your auto block. So depending on how next week is going to unfold, possibly the markets want to return into a near-term discount level. And if we're looking at near-term discount levels, we can be looking at these consecutive down close candles here, this auto block inside the old high from the weekly time frame, because this is current support. Now, why do I think the markets may return back inside the range the early portion of this week? Well, because we had a very strong bearish close on Friday after markets swept buy side liquidity here and traded into a premium. So the markets could make a continuation. Now, mind you, I would not be interested in trying to sell dollar index the early portion of the week. Instead, I would probably just focus on some other asset class where I know that it's pretty one-sided or it's very easy to define. Okay, so I'm going to be studying the daily time frame during the week because I need something on the daily time frame to validate my bias. Now, what's it going to look like? Because last week we're talking about a 4-hour time frame change day in delivery, which still applies this week. Okay, a 4-hour time frame change day in delivery after the markets has traded into a key level is what we're going to use to validate our bias. But also, in case I don't know, maybe you are very unsure of what that looks like. Well, a singular daily candle closure, a bullish daily closure, would also mean the same thing. Okay, just like last week, Monday was bullish. Okay, this by itself means Tuesday is likely to be bullish, and I'm going to show you why it looked like that on the lower time frame, and especially when I go to Euro USD. So there are lots of possibilities. Okay, and I exactly do not know. I can't pinpoint how the markets are going to unfold, because this is where the market's at. Buy side liquidity, we have consecutive down close candle, the auto block here, and which is the change in the state in delivery. We also have here, we have inefficiency here, we have volume balance, this tiny BC fair value gap here. So the markets could trade here and make a continuation. Who knows? I don't really know. Okay, I just want to see how the markets open on Monday. Okay, see if they're trying to make any discount. Okay, the markets could literally just maybe trade into Friday's low on Monday and post new gains. Okay, because why? They are at key level, the previous weekly high. Very possible. Just trade into Friday's low and close bullish, validating the change staying delivery on the 4-hour time frame. Absolutely possible. Why? Because the weekly bias is bullish, and I'm more interested in the weekly bias than how the markets are going to trade. A lot of folks get stuck in their head because of how they expect the markets to trade, forgetting that the markets can do whatever the markets wants to do. Earlier on today, I reposted something on Twitter. ICT made a post. It was talking about how the science behind technical analysis is precision, but in your interpretation of the same things, you have to be very subjective. In fact, let's drop all of the grammar, the English language. Your point is trying to say is that these markets are very subjective, and if you don't have the probabilistic mindset, if you cannot think in many ways that these markets could deliver, then you're definitely doing it wrongly, because the markets can and will absolutely deliver how it wants to deliver. But the only thing with a great deal of certainty you can conceive would be the draw on liquidity and bias. And that's why I taught lots of tools to bring you into the same conclusion. That's why I taught, the COT agent program. I taught data. I taught qualitative analysis, looking at candlesticks and market structure. Okay, so back to the daily time frame, there isn't exactly, you know, any level I can pinpoint, because this is a key level, this old high is a key level. The markets drop into more discount, this consecutive down close candle, and we have inefficiencies along the way. So we just want to see how the markets trade on Monday. Okay, if Monday trades bearish, well, then it means they are likely to trade into a discount. But if Monday trades bullish otherwise, I want you to remember that there is a previous weekly high here, and the market could literally be trying to capitalize on this PDRA, because currently in my mind, I think bias is sort of like obvious. I mean, I think it's obvious because, ran, sell side liquidity here on the weekly time frame. There's a draw on the 3 months time frame. I think bias is pretty obvious, and a lot of people are going to get excited with bias. So the markets could just literally just mess with mess with impatient basically, because that's what they do. Just mess with you because you're very sure you're not going to be patient, so they mess with you, and then you lose money. It goes your way in the end. You're frustrated, rinse and repeat. Okay. So yes, I don't think there's much point going to the fall time frame, because the things I want to say on the fall time frame, those are the things I want to see on Euro USD, right? So I'll probably come back to the fall time frame dollar index, but that's when I'm making there's a comparison I want to make between dollar index and Euro USD, okay? And I'm gonna circle back here. Hopefully I committed to mind and remember. So Euro USD last week we were talking about market drawing into this rejection block, this being the draw on liquidity, and the market in fact trade into the rejection block. This week, obviously our first objective would be the previous weekly low. Okay, that would always be the first objective, and if the market has interest for more sell side, we can begin to anticipate the markets trading into the midpoint of the rejection block. That's 14,884. Okay, that's 14,884. All right, so we have that. That's the consequent encroachment of this rejection block. Okay, the consequent encroachment of the rejection block. So that's the consequent encroachment of weekly rejection block. So markets delivered, sell side last week. We talked about how markets were at key level last week, this rejection block on the weekly time frame, and this consecutive up close candle on the daily time frame. And we said how euros could literally just begin to tank at the open of the new week, which in fact happened. Okay, so we've called out this objective, but first previous weekly low. So now let's go to lower time frame and discuss price action. So on the daily time frame, like dollar index, we have this consecutive up close candle on the daily time frame, which is the bearish order block or the mitigation block, whatever. And primarily I want to eyeball this high here. Okay, so this this low here. So this previously was an old low turned resistance here. Okay, so the markets could literally return back here, and we're going to see how what the market does when it returns to this premium. Okay, their daily time frame looks like the market still has propensity to return to a near-term premium on euro or a near-term discount on dollar index. And mind you, Friday was bullish. Friday had a bullish close after the markets took out sell-side liquidity here. Now mind you, we still have this balanced price range here overlapping the consequent encroachment of the weekly rejection block. So I think the market still has interest for more sell side, not just this week, but based off of the higher time frame perspective. And that's why I showed you what the 3 months time frame looked like, because the anticipation is for this current 3 months candle to draw into the fair value gap on dollar index on the 3 months time frame. So we are going to understand that every run lower is actually a shift in market structure. Okay, so the run lower into sell side here, like you can see, each day's or each daily candle traded into the previous day's low, and the next day the market continued. So this is classic market structure. Okay, look at here, markets created a high, a lower low, but the market made a higher high. This is a torus, okay, at a key level, and the market gapped, created a new low, a lower high, lower low, lower high, lower low. This is essentially, qualitative analysis, and that's what I taught in the mentorship. So if you haven't seen the mentorship, I would counsel you to check it out. And there is something I want to say because I made mention at the start that I got text and actually centered around the same things, which is capitalizing on these setups. And the truth is, a lot of people would tell me that there's a huge gap between themselves as traders and themselves as analysts, and they define buyers to draw liquidity and all of that, but still cannot capitalize on these moves. And the truth is, I think a lot of people actually overestimate their abilities as analysts, and it's something that I've thought to myself before. A couple of years back, I was because I was calling moves like this also, and I couldn't capitalize on these moves. And one of the things I did, I sat back and told myself that why can't you capitalize on these moves? Okay, and I looked at it from the financial perspective. I looked at it from my progress as a trader. Okay, from the financial perspective, I realized that okay, I do not have money I can afford to lose. Okay, and because of that, that impedes my judgment. Okay, I'm very slow to thinking. All right, I would want to say a lot of things aligned if I take trades, and I end up taking low probability trades because I would have missed the impulsive move. Like, imagine missing all of these moves, and I'm now trying to buy. I'm trying to buy the retracement because I am trying to get in on the move to prove that okay, I can do this stuff, and because of that, I lose a lot of money in the end, and it's just crazy. So the solution I came up with, number one, was okay. I said, you just trade the higher time frame. I studied high time frame charts a lot, and I saw that if you call the moves, markets will always respect the 4 hour time frame PD arrays. Okay, when I noted that, I'm like, okay, but the issue now is risk to reward. So greed was coming in again, because remember, I'm trading broke, okay, and I want to make money. All right, and if I'm trading from the 4 hour time frame, probably risk to reward is 3 hour. So I'm wondering, so how do I do it? And the thought just came to my head. If you're really sure about what you say, like you self-proclaimed analyst, you're great at analyzing the market. It means there's a very high chance tendency the market runs to target, right? Okay, why not take your trend in 4 hour time frame and elevate your risk? So instead of risking 1% or 0.5%, risk 2%, risk 3% on that trade. Okay, and it would make do for the risks, the poor risk to reward in quotes. And for me, really, nothing is actually poor from taking from the 4 hour time frame, because it's all centers around your capital, right? Imagine if you're trading on $1 million account, 3% of that, you know how much it is? Okay, do you know how much 3% in $1 million is? So that's that's a lot of money. Okay, but if you're trading on $100 account, you can't talk 3%, and that's why this business is not for it's not for brokies. Really, you can't be broke. Now there's the advent of proprietary firm, but prop firms are very insane because of the risk limit and stuff. So you've got to know what you're doing. Okay, you've got to know what you're doing so before you can survive in prop firms. You get, and that's why while you're trying to perfect your day trading skills, because day trading is literally one of the hardest things to do as traders. I mean, that's why people fail, because they're trying to day trade. Okay, day trading is very, very complex, very, very complex. There are lots of moving parts. Sometimes if you miss a tiny detail, you've probably missed the move, or if you miss a tiny detail, you're going to take a loss, and they are going to punish you for it. Okay, the market is very unforgiving. They punish you for it. So why not? If you're very confident in your analysis, why not trade from the 4 hour time frame? Okay, because if you trade the lower time frame price action, it's subject to liquidity runs, and all of these liquidity runs will just happen at the same 4 hour time frame level. But you are losing 1, 2, 3% on the same level, when you can just allot risk, the same 3% risk on that level, and just wait for the market to do what it wants to do until it's willing to deliver into your objective. So being a trader is actually the simplest thing. Being an analyst is where I think the problem is, because it's not the trader that defines how to manage risk. It's the analyst that defines it. Okay, is this a risk on or risk off market? Do I need to size up or do I need to size down? Where do I need to take partials at the previous day's low or previous day's high? Okay, I'm going to take partials today at the rejection block, because this market is expanding quickly in London session. So I don't think they will take out this low. Okay, I'll take my profit at a near-term discount, and if market offers a retracement, I'm going to re-engage. You're thinking, when you see price action, how do you interpret it quickly? Maybe you woke up 7 a.m. and you open your computer and you're looking at the charts and the market is beginning to spool into your objective. How do you process information? Okay, that's the job of an analyst. What does a trader do? In my opinion, just presses buy and presses sell. Who manages the position? It's still the analyst. Okay, so in as much as these roles are distinct, okay, there's a very huge overlap in between your success as a trader, and it stems from being a very, very incredibly good analyst. So don't overestimate your abilities yet as an analyst, because if you're very good at analyzing the market, defining risk, appropriating risk, and all of that, then you should obviously come up with a solution to being a better trader. It's simple. Analyze your results. And who does that? The analyst does that. So a lot of folks are always deluded into the idea, thinking that, oh, I'm so great an analyst and I'm not so great a trader. The truth is, you may be a good analyst, but not a great analyst, okay? And there's still a lot of work to be done. And instead of gaslighting yourself or trying to tell yourself, okay, I think money is a problem. Yeah, in fact, I agree with you. Money is a problem. I mean, you would do a lot better if you had a lot of money, because if you have an unlimited income stream, okay, you can afford to be reckless, because there's always, a pool of liquidity where you can put your hand inside and take some money and, cover up your ass and stuff like that. And that's why if you check online on Twitter, most traders that are doing well are usually the mentors. Why are the mentors doing well and the mentees aren't doing well? Well, because they have a side income, and probably from influencing and stuff, or from mentorships and these programs, and because of that, they have access to capital every single time. So there's always money to risk and stuff like that. And if you're following this set of people, they actually can't teach you how to trade, because they don't understand trading from the mundane perspective. They don't understand trading from a brokey's perspective. I do, because I traded my way through, okay? So they don't, but you listen to them and you're just wasting your time. Imagine someone open YouTube channels teaching you order block. This order block is going to hold and stuff like that. That's very funny, because that's actually not the issue. What if I see the order block on the 4 hour time frame? And then the next thing is, they can't take the trade. You can't take the trade because you feel that 4 hour time frame stop losses, oh, it's too much and stuff like that, because you're not learning the right things, okay? You should be learning the right things. And that's the whole point of the commentary. When you watch the mentorship, you watch the commentary, because the commentary supplements the mentorship. It's not just about talking about new concepts. How do you interpret these concepts on everyday markets? Because the market is given different dynamics. You can't compare last week's price action to this week's price action. Even if I say I'm still bearish, but you see, I can't pinpoint a certain level I can call the market from, because that is what it is. I'm not going to try to define a level because I'm trying to make people happy that I can call levels. No, I think by now everyone should know I don't care. I really do not care. Okay? Just being honest. Just do my thing, work out, do my thing, work out, reduce my stress, because I'm hustling too. I'm hustling. And I spent my weekend recalibrating. Not because I made money last week, meaning I'll come to this weekend be reckless. Has it happened before? Yes, it has happened before. And how do I know? Well, I journaled it and I try to find out ways I can recalibrate. I listen to lots of music, look at price action, find time, think away from what the market will expect me to immediately do. Not because of you had a good run. Last week is done. This week is a new battle. Trading is incredibly difficult and very, very hard. And there are a lot of people needs to hear this. And I keep making posts on Twitter saying this thing every day. I don't know. I just run out of words, really. And these are lessons you need to hear. Eventually, I'm going to put out, my day trading model on the YouTube mentorship. But for now, if you're developing and you want to find consistency so bad, you want to look back and say, oh, I'm proud of me. If you're good at analyzing the markets, focus on the 4 hour time frame. So last week I was talking about how the markets could open up and rip lower because we already had a run above this buy side liquidity here, and the market eventually created this gap. Now we're going to talk about this gap today. That's one of the things I want to talk about, and I want to talk about how relative strength analysis, correlated pair analysis would help you with your trading, because as soon as the markets open up with this gap, I was in position from the previous week, and I got into position on Monday, because I want you to look closely. When market created this gap, market traded into the gap. Okay, now there are many ways markets can rebalance an inefficiency. One, institutional order flow into drill. Two, they trade into the 50% of the quadrant. And three, they fill the entire range. So the markets created an inefficiency here. Huge imbalance. Here, huge imbalance. I'm going to use this to put the midpoint. So you're going to say it. So, yes. All right. So the markets created this inefficiency, this volume balance, and of course, my expectation when the markets traded, I think this was, let me put the daily session breaks. All right, so this is Friday's low. So Monday, the early portion of Monday traded quickly into Friday's low. What did I say when markets meet objective? You want to wait. Why? Because they're likely to return into the range. Listen, but if there is an inefficiency like this, what would you be expecting? The markets to trade into the inefficiency, right? And the market did just that. Now, markets is mere objective, but daily time frame. Now, there's a weekly draw on liquidity where the market wants to reach for, right? So it means when the markets makes a retracement, you need the markets to reestablish the high time frame order flow. And how is the markets going to do that? The change in the state in delivery. So that takes us back to the 4-hour time frame. And you can see this level, this up close candle prior to the run above buy side liquidity here. That's the change in state in delivery. And the market did that before the trade into previous day's low. It means that when the market returns back into the range after the change in the state in delivery, okay, it's returning to rebalance inefficiency to what? To make a continuation, because as soon as this candle closed below the bodies of this candle, the weekly bias has been established. As soon as this candle closed below the bodies of this candle, the weekly bias has been established. So now that we know the weekly bias has been established already, and the markets returned back into the inefficiency. So let's look at what happened in London session. This is London session. Yes, this is London session, and you can see what happened after the market traded into this inefficiency. There was an hourly time frame. Markets created an order block on the hourly time frame. Now this order block that formed, okay, this order block that formed here, market returned back into it, and market pushed the sell side. My expectation on Monday was, I was thinking, okay, now the market has been exaggerating moves. I'm going to expect the market to take out this level here, and I'm going to collapse a portion of my trade. And the market started consolidating, and I think I went to bed because I was awake through Monday midnight. I took a setup on gold. I was buying gold. Okay, I had gold trade on, I had Euro USD trade on. London session, I engaged Euro USD again, apart from my entry from the previous week, because I sold Euro USD the previous week. So I had all of these trades running, and I was so exhausted, so I slept. So by the time I woke up, markets were very, very close. And this particular trade, I'm talking about my trade, I had my stops on an intraday basis. So you can look at the 30 minutes time frame. You can see this 1-2 candle, this consecutive upwards candle. That's a change in the state in delivery. Okay, you can see here. So it was a 30 minutes time frame exactly. I used to define my entries. Okay, you might not see clearly, but this candle closed below the bodies of this candle. I sold on this candle, market returned back, and started exaggerating moves, which was really, 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 really good. I thought we were going to engage this on Monday, but we didn't engage this on Monday. So I think I returned back to break even, and I had to engage the following day. Poorly managed on Monday, poorly managed. I would accept that. So, but I had the trade from the previous week, and I want to go into Tuesday's price action. Okay, now recall this market returning back into the range basically is this market consolidating, because if this market were going to move, be very, very one-sided, you do not need to return back to a premium. Now, where did it return back to? You can see the change in the state in delivery. You can see the change in the state in delivery. Now, someone says, "Oh, I called the market, market trading to objective." Well, how did you interpret markets on Tuesday? Because this is Tuesday's trading. Okay, this is Tuesday's trading. Okay, let me put the session breaks. So this is Monday, Tuesday, Wednesday, Thursday, Friday, TGIF. So Tuesday, how would you interpret Tuesday? This is how I interpreted Tuesday. Markets return back into what? The order block. Mind you, I said when markets are in consolidation, markets can revisit key levels multiple times. It's nothing like unmitigated levels. There's nothing like that. Well, sometimes there's something like that, okay, because everything applies in the markets. But don't be deceived thinking that markets cannot return back to the same level multiple times. Okay, then you're being deceived. Okay, the market can reclaim a level multiple times, and that level is still going to act as support or resistance, right? So on the morning of Tuesday, the market returned back here, and on the lower time frame, you can see this market. You can see, I think it was 15 minutes time frame. So markets returned back here. Markets were consolidating, and this was London Open. That was 1 o'clock, 1 a.m. Eastern time, and you can see the markets create a fair value gap here. You can see the markets create a fair value gap here. Not just create a fair value gap. There was a short-term high here. Market ran through this high, closed below. This candle here is the change in the state in delivery here. This candle, that's the change in the state in delivery at key time of day. Mind you, markets are already graduating from a key level. Okay, that's the key level. So this is where ideally you should be buying from. But the reason why I'm calling out here is because this is the London session, and our flagship pattern for this year is the change in the state in delivery. So since bias has been validated on the 4-hour time frame, since the market only returned back to the 4-hour order block here, and markets is beginning to go lower at key time of day, you want to be looking for flagship patterns you can use to engage the market. So you can see there's a change in delivery, there's a fair value gap, that's an entry. For folks that really cannot go through lower time frame, and folks that cannot think quickly, because you need to think quickly, you need to understand where is this move coming from. You can see there's a level has been hit, then there's session. I'm going to teach time and price in the mentorship too, why I was thinking to make considerations for the change staying delivery on the 15 minutes time frame. What does the session have to do? Okay, mind you, I thought something about sponsorship and manipulation using the economic calendar, and there's something about the session and time of day, how they contribute to the daily range. Okay, it's something we'll talk about. So say you could not interpret that. Okay, another entry came on the 4-hour time frame, and that's this fair value gap here. The market's trading into institutional order flow entry drill. What does it mean? It means you can. Why do I think it's an institutional order flow entry drill? Because we have a swing high form here at the key level. We have a swing high form already. So it means the markets are likely to attack sell side first. So that's why this institutional order flow entry drill, I qualified it on the 4-hour time frame. And if you look closely, even on the 60 minutes or the 12-hour time frame, you can see these candles 1, 2. This candle closed below. That's the change in the state in delivery. That's the change in the state in delivery where the 4-hour time frame fair value gap. Institutional order flow entry drill, change in state in delivery, market return back here, sell. Collapse a portion, collapse a portion, collapse the entirety of your trade, which is also fine. So there are about lots of ways you can you can take an entry on the market, but you just have to pay attention. Now there's something I'm going to talk about, because you know, when the market made a retracement on Euro USD here, and you know, someone will be thinking, said, what about this fair value gap? What if I was thinking the markets were going to fill this fair value gap? You know, that's where correlated pair analysis will come in, because if you look closely here, GU completely rebalanced this inefficiency, and didn't only rebalance this inefficiency, also took out, you know, this high again on the 4-hour time frame. But because of we understand bias, we understand that dollar index was bullish. A shift in market structure, a run above buy side liquidity when institutional order flow is bearish, is what? Is a Tory soup. Look at here, this short-term high, market ran through. It's a Tory soup. Look at this highs here, the market ran through. It's a Tory soup. Look at this short-term high, the market ran through. It's a Tory soup. So that's how it is, really. Someone said, okay, how am I going to engage GU on the high time frame? It's very simple. Reference these two candlesticks here, 1, 2. When this candle closed below it, it didn't just only close below this one, close below this one closed here, but this is our reference. So as soon as this candle formed here, at what? This is London session. This is 1 o'clock. That's when this candle opened. That's key time of day. And you're seeing sponsorship. What sponsorship? The change in staying delivery on the early time frame. And that's why I was not putting anything into consideration until the London session. So why GU traded through and rebalanced this inefficiency here? EU didn't completely rebalance this inefficiency, only returned back to this. And GU run higher. So this is an SMT between GU and EU. Why is it an SMT? GU made a high and EU made a lower high. So that's an SMT. And why do you think it happened? Well, if you check Euro Pound last week, the early portion of last week, Euro Pound was extremely bearish, giving relative weakness to Euro and relative strength to Pound. So Pound kept on making very deep retracement. That's why if you compare price action between Euro and Pound last week, Pound kept on making insane amount of retracement. So ideally, this retracement wouldn't have happened if maybe Euro Pound was flat and both Pound and Euro USD were both moving with dollar index. Okay, so that's how you make solid analysis, and that's how you get confident in any setup you're going to be taking here during the London session on Euro USD. Why? Because you already investigated GU and so okay, GU completely rebalanced this. There's a change in state in delivery at key time of day, the London session. So this is likely an SMT. Why? Because dollar index is bullish. So when you see this and then you look at Euro USD, you would have confidence to engage. There's a lot of analysis that goes in, okay, to engage. And it's going to take practice. It's going to take years of practice, because sometimes you're going to forget. Sometimes you're going to wake up feeling drowsy and you'll be looking at the market and your head is not clicking. And then when your head finally clicks, the market is left you. It's part of the training. Now, if you're like me that learns things from the holistic perspective, on the near term, you're not going to feel like you're making any progress. You're going to try to compare yourself with folks, because there are folks that you can just give them 1 + 1 and they're going to do something with it. Yeah, they're going to do something with it. But you need more than 1 + 1. You need to understand, how did 1 come about? What's the reason behind 1 itself? And when you add it to 2, what's the significance of 2? You know, you're going to look at varying variations of 2. You're going to look at 2 in Roman numerals. You're going to look at 2 in the Arabic numerals. You're going to just do in-depth study of 2 before you can fully understand that 1 + 1 is 2. Now, on the short term, you would be clueless, but in the long term, you're going to know 1 + 1 better than the person who just quickly understands. So you can't compare your progress. You can't do that. You simply cannot do that to yourself. You can't compare yourself with the next person. You can't say, oh, this person is doing well, we started together, I'm pressured. No, don't do that to yourself. That's the thing. People don't even know themselves first. Try to know yourself. I mean, know yourself. This is trading. The market is supposed to have exposed your personality to you already. Well, the market exposed mine already. And look at this very beautiful setup. I could share you all of the screenshots during the week, how I was participating in all of this market, and you'd be like, this cannot be, it's not true. Well, it's true. And at the end of the day, I'm usually very extremely exhausted because this takes a lot of brain power. Because mind you, at the end of the day, I'm not analyzing because I want to. I want to allocate risk. Yeah, I'm going to allot risk to the trade. So at the back of my mind, I'm going to put my money where my mouth is. So it's very, very exhausting because you want to look at every tiny detail, every nuance matters. So that's what you want to be doing. So this commentary is majorly, we want to review last week's price action because I think I got a lot of text. The same, very similar thing. The markets can be very, very one-sided, and I promise you, you're not going to make money in it. Because markets being one-sided doesn't mean you're going to make money. But the easiest way for you to make money is just if you can subject yourself to the 4-hour time frame. When the lower time frame are getting messy, just take your trades off the 4-hour time frame. You can always get subsequent trades, but first take that one and calm down. Calm down. Sure, you get. Like, take that trade first and be calm. Because there was a journal I had written, it's almost 4 years now. I told myself, the times you lose money are times when you're very sure of bias. I mean, does that sound very familiar? And I just figured that when I'm very sure of bias, the need to want to get in and capitalize on the move, to express skill, to be that trader and stuff like that, it just bops and, I just make mistakes, poorly managed trades, even if at all I manage to get in a setup, and stuff like that. And I just end up, in shambles. When I realized that the trades I took are trades I wasn't even willing to take. I mean, I was very nonchalant about those trades, and I saw them and I'm like, wow. Just imagine if you're not looking at the chart and suddenly you just open the chart, maybe New York session on Thursday, and you saw the market raid this previous high, and a run above this high, it's a Toro soup, and you've seen a change in state in delivery, and you see this fair value gap. You just go in and sell. You didn't care about what was going on here. But by the time you stay on the chart, it's very difficult to always look at the chart and not assume something. If you're always looking at the chart, you're definitely going to see something and you want to take something, and then that's how they take your money, because you do not efficiently profile the markets and stuff. Now, that doesn't mean here it's not a tourist, because in my group chat, me and my friends, we took USD sell here when markets ran above this high and there was a lower time frame market structure shift. We sold it. But what's your expectation? You want to collapse here because this is the initial low of the day. Now, if you're not going to collapse here, it means you're willing to take on the risk if they return back into the range and possibly stop you out. So if you're doing anything, you have to be mindful. I put up a tweet sometime. I said, mindless trading is not emotional mastery. You don't put on a trade and expect the markets to just sometimes do all the work for you, especially when you're trading on this lower time frame chart, because it gets crazy when you're trading on the lower time frame chart. They demand so much from you. Now look at this price action around London close session. Market trade above buy side liquidity here. Again, there's a change in state in delivery. Market return back into this low here. That's a sell. So even if you didn't have so much, you notice there's a consistent pattern that the markets keep on forming. All you need to do is to blend time and price. When I mean price, key level, I mean market structure too. So to quickly wrap up this, I really covered a lot of things, looking at the market review, looking at what correlated pair analysis means for your analysis, and how sometimes slow thinking impedes your participation in the market. And not to worry, you just have to keep on training yourself and pushing. All right, so we talked about this week's price action, what my expectation, okay, for the markets to draw into buy side liquidity here, sell side liquidity here. And I'm thinking the markets might be very tricky this coming week because apparently I cannot visibly classify a level in the higher time frame except this low here. So I want to see if the markets make a retracement into this level and probably reject or form maybe a bearish candle closure, validating the weekly bias, or some 4-hour time frame change, then deliver after market trades into this premium, something to that effect. And subsequently managing my positions day by day. I hope you found this one insightful. Until I see you in the next one, be safe.